Hey, this is Matt Taub, financial advisor. I'm here to discuss tax-free retirement income solutions, and obviously my face and picture are in the way of our beautiful graphic here, so I'll move myself out of the way. A lot of clients we talk to and work with are interested in how to derive income in retirement that is free of any taxation, won't show up on their adjustable gross income, and is also free of market risk. And so this presentation is meant to show how we derive those solutions. So this next slide actually covers that very point. So beyond the limits, or apart from, let's say, a Roth contribution to a 401k or a Roth individual retirement account IRA, both of which have upper limits from the IRS, a lot of people want to know how they can produce this sort of solution on their own. And many of the times people are concerned about rising tax rates and the underfunded or unfunded obligations of the U.S. government. At the time of this presentation, the government is yet again in another sort of debt ceiling crisis, and how are we going to see a resolution to this over time? Honestly, I do think what will end up happening is the possibility that both income taxes and capital gains taxes get raised. Obviously, no politician would want to do that. What they'll end up probably doing is passing some kind of bill that temporarily lowers taxes, but sunsets with a trigger that if nothing is resolved in the future, tax rates go up dramatically. And that way those politicians can take credit for having lowered your taxes, and they've actually secretly solved the problem by having a deadline where taxes go up, and at the time that the taxes will go up, the politicians will point fingers and blame each other, and nothing will get done, and miraculously we've solved the problem that way. I see that as a very dire fate for anybody who can't get ahead of it, and if you can get ahead of it, obviously that's why we're talking and having this conversation. So in addition to all of that, at the federal level, you may also be someone who lives in a tax-heavy state. There are many states that people enjoy a nice standard of living, but those particular states and municipalities also have a lot of taxes that are triggered by what income you show. So again, just kind of looking at this sort of scenario of where taxes are headed, the United States debt increased 91% from 2012 to 2022. In light of that, where are taxes likely headed? It's a high probability that taxes are going to go up. If you look at what happens when we have a debt to GDP ratio where the debt becomes a large portion, or it's a large ratio of the debt to our overall GDP, the income tax rate responds to that. And not only does it respond to that, and here we have obviously World War II, but you actually see sustained higher tax rates for quite some time, even after the debt obligations begin to go down. And so the problem is for a lot of retirees is, are we currently here, and could your retirement be entering a tax period here? And if we can get ahead of that, that would obviously be optimal for at least a portion of your portfolio. So that is the question a lot of clients ask. Is there a way to get ahead of this? And yes, there is. Not only would taxes possibly go up, but taxable income actually triggers other taxes. Meaning, if you draw income that's pre-tax from a 401k, and even withdrawals from a brokerage account, despite the fact that those are subject to capital gains taxes, are all considered part of your adjustable gross income. And guess what? The taxation of your Social Security and the premiums you pay for Medicare in retirement are all predicated on that either adjustable gross income figure, or for Social Security there's something called combined income or provisional income, which gets super complicated very quickly, but basically how much income you show, that's either income tax income or capital gains income, in addition to half of your Social Security benefit itself, determines whether your Social Security is taxed. And for many people, if they don't have a tax-free retirement income, 50% of their Social Security is taxed, or even 85% of it is subject to being taxed. So a lot of people look at this and they see almost like a double whammy of taxable consequences. And so that's where the goal for a lot of people is to get to a 0% tax bracket for income tax and retirement, to have their Social Security untaxed, to have the lowest possible Medicare premiums, and no risk of changing or likely increased taxes in the future. Not everyone can get there, and for some people it's more just deriving a portion of their income to be tax-free and free of this risk. So let's just review here. This is maybe helpful for a lot of people as sort of the three buckets of where you can put money and what kind of taxes it receives. So obviously most of our clients, they have built up a significant balance having deferred taxation or actually deferred their taxable income into some kind of retirement account at work, a 401k, a 403b. Maybe that's been rolled over now to an IRA, an individual retirement account. Often they'll hear the words pre-tax or traditional in terms of their contribution, meaning that they deferred taxation on the way in. The balance has grown on a tax-deferred basis, and there's a looming tax bill upon withdrawal. Any withdrawals from this environment are subject to income tax. And then obviously we have an account we call a taxable account, and that's an account that there was no taxation, there's no deferral of taxation on the way in, but something like a brokerage account or just some kind of investment account, even a high yield savings account or purchasing something in that kind of realm, you might have capital gains tax treatment, especially if you have dividends, investment changes where you sell something at a gain. Those would all be subject to capital gains tax, which could be 15 or 20% based on other income you're showing, plus what's called a net investment tax. So commonly there you might be looking at like an 18% or 23% taxation there. And then obviously we have post-tax, or now tax-free. You've paid your obligation, whatever it was, and you've placed your money in an environment that there is no further taxation. The most common one people are familiar with is a Roth IRA or a Roth contribution to a 401k rather than the pre-tax or traditional contribution. There's also tax-free retirement accounts, which we'll get into. Commonly, other than special financial structures, and it'd be helpful if I could spell structures correctly, the most common way that we see people use tax-free retirement income is through the tax shelter of life insurance. And so this is where we look at this world, and again, if I can spell structures correctly, that'd be nice. And we would like to see the ability to take money, pay taxes on it, and never pay taxes again. And so for a lot of our clients, if they have a significant surplus income, if they have money on hand from the sale of a business or an inheritance, they often ask what of these three buckets makes the most sense or is available to me, and that's where we're really pointing them to this world of saying, look, if you have surplus income, you commonly pay the taxes on that income before it's in hand. If you have an inheritance, that money is coming to you with usually a stepped up cost basis, or it is just fully cost basis. There's any taxes that were owed has sort of been satisfied already. The sale of a business, we might have some advanced structures to deal with, but if we're already post that sale and you already have sort of the net proceeds, why not have that money never be taxed again? That's the question we're asking people. And so obviously one question someone might have is, okay, well, can't I, if I have a 401k through work, do a Roth contribution to my 401k? From a tax perspective, that could be similar. There's upper limits of what you can do there. Same with a Roth IRA. And both a Roth contribution to a 401k and a Roth IRA still have market risk. And we have seen the stock market have terrifying dips and even like a 10-year lost decade from 2000 to 2010, where if you put money in the market in 2000, there was a dot-com bubble that kind of burst, and then we had 9/11, a recovery from there, and then you had the 2008 crisis, and as a result, you might have had the same balance if you put it in 2000 into the market in the year 2010. In 2008, and really it's the fall of 2007 to March of 2009, you had something like a 53% drop in the S&P 500, and it just continued to drop, and a lot of investors sort of were caught waiting for some kind of recovery, and this permanently damaged many retirees' portfolios who were trying to retire into that sort of cycle. And that could actually trigger what we would talk about, which is the sequence of returns risk for just keeping all your money in the market. So here we have, and I'm going to dance around a little bit just to be helpful, but you have the possibility that you could have simply a bad sequence, even with a Roth IRA or a Roth 401k, if it's still market-based, right? If it's still something that's sort of riding the whims of the market, and you just happen to retire into that sequence, As shown here, you have a bad year in the market, and you also have the need for your withdrawal for lifestyle. And you sort of lock in that loss. And if that happens 3 years in a row, like a 2000 to 2002, it can irreparably damage your portfolio. The market had done its damage to your account balance, and you had to take a withdrawal. So as a result of those two incidents happening multiple times in a row, there's just not enough money left to experience any positive returns thereafter, and you continue to take the withdrawals you need. The damage is already done. You literally can run out of money. Even really good returns later on don't even matter to you because the game's over and you've literally run out of money. Obviously, we don't have any control over that sequence. Any advisor who tells you they can predict what the market is going to do, I would turn that Zoom meeting off or walk out of that office, because good financial planning is done in the absence of knowing exactly what the market might do and trying to plan around it with things that either have enough time to grow, that we don't have to touch a certain bucket of money, and any momentary or 3 year in a row aberration would revert to a mean or a norm after enough time, or we have buckets of money that can't suffer market risk. And that's part of the design here. Not only are we looking for tax-free retirement income, we're looking for free of market risk retirement income. What most advisors will show you instead is the rosy scenario of, say, 3 up markets. And again, these returns are just the same returns, but they're just reversed, meaning these good returns over here at the end here, these bad returns here at the end over here. What we're trying to show you really is, if you had 3 good years in a row, then as a result of that, you have almost instead of a downward spiral, almost like an upward spiral. It would be almost impossible to outlive your money, and you might think you're a financial genius, but you just got off to a really good start. A lot of advisors will show you that scenario or something like that scenario, and they'll say there's something like a 90% chance or a 99% chance you'll be here or somewhere over here. And the problem really is not the probability of risk, it's the consequence of risk. What if that 1 or 10% scenario occurs? It's kind of cold comfort to you that 90% of the time this wouldn't happen. If this happens, the consequence of this happening is irreversible and devastating. So can we take that risk off your plate, along with the risk of increased taxes, and take that off your plate? Right now, a lot of people that we talk to, where they are is using safe sort of risk-off investments. So we see people who are saying to us, I have $2 million, I have $3 million. I'm taking advantage of a CD at my bank. It's paying me 4.9% interest for the next 2 years or 3 years or 5 years. And we agree that's good. Safe returns are available that remove that risk for now. Obviously, a money market fund with Vanguard, you can get 5.27%. It's fully liquid. That's tremendous. But these sustained higher interest rates that cause this risk-off return may not last forever. If there is a downturn in the markets, it is likely the Federal Reserve would respond to a market downturn by lowering interest rates to juice the economy. And all of a sudden, overnight, you could see a money market fund paying 5.27% suddenly pay what it paid 2 years ago, which is next to nothing. You could see a CD that you locked in, and you enjoy that nice return, but the end of that term comes due or comes up, and you have what's called reinvestment risk. You have to reinvest, and now the offerings from CDs are 1% or 0.05%, like they were not too long ago. So with that in mind, if we think 4.5% to 5.5% is good with no risk, how about 6 to 7% annualized returns with no risk? No downside risk, no rate renewal risk like money market or CDs, and eliminate taxes. We can do that. The answer is something called Index Universal Life. This is using the tax shelter of life insurance to grow wealth, and if you can qualify for it, you have tax-free retirement income, no market risk, a 6 to 7% tax-free return, and this we see as a perfect complement to other market-based assets. In fact, it allows other market-based assets to more intentionally pursue growth. We have clients who do one of two things. They either have a growth portfolio and they use this Index Universal Life, also known as IUL, and the two of those things sort of complement each other in a way that the market-based assets go aggressively for growth And in the event of a down market, the client pulls their income tax-free from the market risk-free bucket of the IUL. And in the event of an up market, the client leaves the IUL alone and pulls some winnings off the table from their market-based solution. Other clients, it's more that the index universal life, along with a majority of investments in some kind of protected income bucket, commonly using any combination of high yield savings, CDs, money market, fixed annuities, and fixed index annuities. All those things plus the IUL become their no market risk income bucket, and they're using that instead of kind of pairing it one and then the other based on up and down markets. They're using that money first, and they're letting the other growth portfolio go for growth and accessing that thereafter later. Other people do it just the opposite way. They use their growth portfolio first if it has tax liability, and they spend that down, and then they let the IUL, which is tax-free, build. So your case and your circumstances, it's going to depend what other pieces in the retirement puzzle we have to work with. But ultimately what you can see is that we often use bucketed strategies to have one piece on the board complement another. If one part of your portfolio pursues risk and growth, we have another bucket to complement that has no risk, and in this case also no taxes. So this no risk bucket allows other money to then therefore more intentionally take risks, because we don't have to draw from the risky money in a down market. So I hope that's helpful to see how actually each piece complements the other and lets you maximize your position on all fronts. So this might be helpful to just give you sort of a primer. What are the different places I can invest my money? If I have surplus dollars, obviously a brokerage account is the most liquid. You put money in, there's no IRS limits, there's no medical qualifying the way there is with life insurance, and you have all types of taxes and risk. So yes, there are tax loss harvesting and direct indexing strategies, but you're still exposed to taxation, and you're still exposed to risk of the market. So you have the liquidity. There are some advanced strategies here to try to mitigate those taxes and obviously mitigate that risk, but the trade-off is more liquidity for more taxes and risk. If you're working, you have a 401k or on your own an individual retirement account, IRA. The traditional or pre-tax way to put money into that environment is to tax defer the money in. And so this money has actually lowered your taxable income on the way in. There's no taxation along the way. You still have risk along the way, and certainly sequence of returns risk in retirement if you don't take some of this money and pair it off or break it off to build some kind of protected income bucket. And there's going to be income tax on the way out if it went in pre-tax or traditional. Finally, a lot of times we have clients who say, let's see if we can use the 401k or IRA money, and they're now quite far along and they're kind of staring down the barrel of retirement. And what we end up doing is we sort of take this money from here and we break off a good amount of it and build a protected income bucket using the highest possible yield we can get, which is a fixed index annuity where the tax deferred nature remains the same, but we've simply taken the risk and we now have no market risk. We have the ability to capture upside in up years, but we stay neutral or level in down years, and that way we can responsibly take from this portfolio along the way. And that is a very good solution, and a lot of times we'll put enough in this environment to draw the client's income, and that allows remaining money to continue to go for aggressive growth either here or a combination thereof. So why not just stick with that and use that strategy? Well, as you can see, a lot of clients, they do. That's what we can do for them. But once in a while there's someone who's young enough and they have enough surplus income that they could actually do everything that a fixed index annuity is getting them. But they can also eliminate taxes while also providing additional death benefit protection, which can double up as a long-term care benefit. And that really is the tax shelter of life insurance to create tax-free retirement income. So an index universal life policy, similar to a fixed index annuity, tracks a market index, captures gains from a market index, is neutral in years that the market index has a negative return, so there's no market risk. And it also has the ability to withdraw money without taxes, tax-free. It's through a process called structured loans, which we'll get into. And the reason that that money is tax-free is that it's hanging out underneath a death benefit. God forbid something happened to you. And if it doesn't, and God forbid there's a long-term care event that happens to you, that death benefit could instead be used as long-term care protection. And so that death benefit / long-term care protection is a tax shelter under Section 7702 of the tax code, the IRS tax code, that allows this money to come out free of taxation. And so all we need to do is make sure that you take out an amount of money that the death benefit remains in place. And we'll get into those details now. So obviously when you look at this universe, what seems the most appealing in terms of tax deferring, no risk, and no taxes on the way out would be the Index Universal Life. So let's review the pros and then the cons of Index Universal Life. The advantages of the pros is tax-deferred growth, tax-free retirement income, no market risk. It has a tax optimization similar to a Roth, but without IRS limits and without market risk. You get a death benefit that can actually be used in this case as a tax shelter. Long-term care protection with that death benefit can be more appropriately used during your lifetime to cover a long-term care need. Also for upper high net worth or ultra high net worth people, we use this structure as estate tax protection. So if someone accumulates an amount of assets that they're worried about facing the estate tax, they actually put their assets into this sort of structure, and they even offload it with our tax planning department into an irrevocable life insurance trust, or an ILIT. And that's something that we get into with advanced planning cases of someone who's facing the estate tax of currently over $11 million for an individual, or $22 million for a couple, although that's going to change and go back down in the years ahead. Also, crucially, no advisor fee. This money doesn't have any kind of ongoing advisory fees. What are the cons or downsides of an annuity? Well, not everyone can get it. You have to pass medical underwriting. It does involve life insurance. So there's not only that, but there's also at least a component of your money. While there's no advisor to pay, there's part of it that does go to the cost of insurance. There's going to be a percentage of people who purchase an Index Universal Life policy, make one payment, and unfortunately pass away. And the insurance company is on the hook as much as you are in some ways, because maybe even more, because they're going to be obligated to pay whatever the death benefit is on that policy. And so a lot of people look at an Index Universal Life policy, and it does need a couple of years to begin to accumulate, because in the early years, a good portion of the money is siphoned off to cover that life insurance risk, which, by the way, does protect you as well. As a result of that, and removing market risk, this is not an asset class that you're going to get that maximum yield of riding something like the S&P 500 or a super aggressive fund trying to get like 9 to 12%. A reasonable expectation in this environment is a 6 to 7% return. But this is a tax-free return. Arguably, you could say a 401k, if it's traditional or pre-tax, earning 8 to 9%, actually after taxes does produce the same return here. So I'm not sure I totally agree with that criticism. And actually, with that in mind, I also want to talk about a number of common objections we hear to Index Universal Life that are usually unfounded or erroneous. First up, Index Universal Life contains insurance costs that are not found in a regular investment account. Yes, that is true. These fees or costs provide something. Namely, they provide a death benefit, which also can be used as long-term care coverage, and these are usually critical needs in any financial planning case anyway. Those are usually things that we find are people are underinsured and haven't solved for long-term care sufficiently, and they could always use more resources there. I would consider this. An Index Universal Life policy provides tax-deferred growth, tax-free retirement income, no market risk, provides a death benefit that doubles as long-term care coverage. That is an extremely advantageous combination of benefits that certainly outweigh the insurance costs, and simply you can't obtain all of those benefits in any other single financial structure. So I think that's a foolish way to look at Index Universal Life. Yes, you're paying for an insurance cost which provides an insurance benefit along with your wealth accumulation. Another criticism is that the performance of these products drags against the S&P 500 or a comparable aggressive fund. So this is really not an apples to apples comparison, because what you'll see if you go on the internet is someone taking a column of the S&P 500 and a column of the Index Universal Life Policy and say, see, the S&P 500 vastly outperforms it. This is stupid. The problem with that is that you have in this case, an investor in the S&P 500 would have long ago tightened up in terms of their investments. You know, if someone who's in their 50s, maybe they would still be in the S&P 500. I doubt it. And as they enter their 60s and 70s, to avoid that sequence of returns risk, they are not going to continue to be in the S&P 500. They will have long ago tightened up to a moderate or conservative portfolio, be lucky to be earning 4%, 3 to 4% in a conservative portfolio. So the S&P column tightens up, right? In the meantime, this IUL continues to earn that 6 or 7% year after year. And so actually, this 6 or 7% return, and by the way, is tax-free, is a tried and true return through and through, and with no taxes. And you add all that together with the fact that your other aggressive money is allowed to grow more. We're not saying do everything you have into Index Universal Life Policy necessarily. We may have someone have a separate aggressive investment account. That this is a perfect complement, because that aggressive account can now go for growth, and in a down market we have the IUL to rely on, free of market risk. And so only in up years do we draw from the aggressive investment account. Finally, are these insurance products oversold for commissions? So there's a one-time commission called target premium. It's clearly listed on any life insurance illustration, and after that the advisor or insurance agent collects no further fees. In contrast, we manage money. We have a lot of solutions for managed money. We're happy to manage your money if, as fiduciaries, we feel that is the best solution for you. That would actually incur you an annual fee, which we would justify charging you. But when or if we see something that, yes, it's true, we live in a capitalist society and it will pay us, it will only pay us once and never again. If it's to the benefit of the client, we're going to show it to you. We're open to anything. We're an independent firm. We're open to anything out there that can help you. That is, and actually as an objection, is a stupid objection, because you'll pay less over time doing IUL than you would with an advisor charging fees. There are times where there's compelling investment opportunities that a fee is justified, but again, if we see a client who isn't eligible for this, it jumps out at us as something that we can obtain a really great result. No fees from an advisor, no market risk, no taxes from the government. So just to review here, what does an IUL provide? It provides tax-deferred growth, tax-free retirement income. Again, we're going to talk about this through structured loans, additional life insurance protection, favorable structure for estate planning and legacy planning. Your heirs get a tax-free death benefit. That death benefit doubles as long-term care coverage, and there's no market risk. This is so favorable, actually, we have people we talk to all the time. They finally educated themselves. They want it, and they can't get it. I might have to make myself a little smaller here so you can even see this. Let's go over here. There we go. We have people who say to us, I understand this. I've read books about this. Can I get this? And they're uninsurable. They have poor health. They're too old to be insurable. They've finally accumulated the assets. They're 75 years old. To get life insurance at that age, it's just at that point, too much would go to the cost of insurance. It doesn't make sense. We need someone who probably is around 57, 58 years old or younger. Is probably the cutoff point. And there's some critical years there. If somebody is like 53, 54, 55, you get to like 56, and we start to edge it out. It's going to start to depend on your health when we get to about 56 or 58. But lower than that, we're in great shape to really have very little go to the cost of insurance. If you're older, you also have a problem that there's just not enough time horizon for favorable accumulation. You have to remember that the IUL policy, it kind of looks, instead of looking like this, it sort of has that cost of insurance at the beginning, and then it looks like that. So in that early period, you do need to get through the insurance cost being paid for, which does provide a death benefit that can be used as long-term care coverage. Finally, there's people who are healthy, but they don't have the funds available to make this commitment. Either they just don't have the funds, or their assets are in qualified accounts, like they have a couple million in a 401k, but that money is all pre-tax, and to get that money out of there causes an income tax situation, and that would be difficult for us to justify. Or their assets are tied up in some kind of other illiquid investment or difficult to unwind. So really, if you're watching this presentation, it might be that we've spotted you as what we'd call the perfect candidate for Index Universal Life. You have the health to qualify. You're young enough. You're healthy enough. You've got a time horizon that you're not looking to touch this money for a couple of years to get through the insurance cost. And you have the ability to fund it from liquid or near liquid assets, surplus income, inheritance, or any other windfall. Those are what work best. Your accumulation need is for a different asset class, meaning you have a separate bucket perhaps that is going to go for aggressive growth in the market. But along the way, if there is a dip in the market like here, we have some kind of structure through an IUL that can complement that. And so also if you're younger and you're working, perhaps you have a death benefit need. Certainly you, almost all cases, have a long-term care need, so those things can kind of double up together. And then the ultra high net worth folks often have estate tax planning need, but a lot of times there's just regular estate planning needs, which is that in addition to your tax-free retirement income, the remainder is going to go as a tax-free death benefit to your heirs. If you are the perfect candidate, IUL is a perfect fit to solve for either later retirement income, or you have it as the safe money bucket in down years, meaning your aggressive investments, you don't have to withdraw from those. Maybe this and other protected income solutions are your money to draw from, your permission to spend bucket, while other money goes more intentionally for growth. And that is really portfolio diversification of your retirement income. It does give you a death benefit, long-term care, and estate planning, all through a single financial structure. So a question we usually have at this point is, okay, explain to me this process, this structured loans process. So the loans are from your future tax-free death benefit to your heirs. Meaning if you didn't touch the death benefit, it would continue to grow. But what people end up doing is taking loans from an accumulation value that hangs out underneath their death benefit, and as a result of taking that income, which is tax-free through these structured loans under this section or code of the IRS Code, it's actually the section 26 of the US Code. I actually also am a non-practicing attorney. This is allowable under US tax law to take this income as structured loans, and all it does is simply reduces the future tax-free death benefit to your heirs, and there's simply a limit where you can take about 90% of this accumulation value, and usually what we illustrate for people is taking out what they need for lifestyle year after year, up to the limit of what they can do, that there's a death benefit that remains, and the structure remains allowable under U.S. law to be tax-free retirement income. Very common, used for decades, and is a solution, again, if you qualify based on your health and time horizon, right? So the loans can be illustrated in a number of ways. Layering them as recurring tax-free income is most common, but you don't have to choose how you'd access this structure now, right? I mean, it's always flexible. It could be something that you end up saying, you know what, my other money grew in a nice upmarket couple of years, and let's delay taking from here for now, and I'll take from here later. It's there for you. We just want to show you in an illustration what is the maximum that can come out year after year, so you know what you have to rely on. Speaking of what you have to rely on, who do we use in the insurance space is very important. We are contracted with every major insurance carrier out there. That's what we call massive legal reserve insurance carriers. We're looking for carriers that stick to or meet the following criteria. They're extremely well capitalized. They have a strong financial rating. They have high accumulation in terms of the ability to have this grow handsomely, and low costs or fees to the insurance company. And then perhaps most important, we want to use companies that have accurate illustrations. This is perhaps the most important feature. There are some carriers known to illustrate too well. The illustration that you see, unfortunately, will not comport to the reality of your experience, and it's very important to set realistic expectations. If you've worked with me, you know most of my planning, I'm sort of under-promising and over-delivering. I'd like to have a client's review meeting be, Matt, what you've shown me is less than actually the experience I've had. We've done better in real life than what you've shown on paper. And so we look for insurance carriers that we can see a track record that the account values in their policies in terms of what was illustrated versus what have actually occurred generally tracks with what is happening in the real world. Obviously, there are times that there is a dip in the markets. There's times where the markets do better, right? And obviously times that there was a bull market. Things do very well, and obviously 2022, things fell off a little bit. But we see generally what we're showing you is tracking with reality very well. So if you're someone who thinks this might actually be exactly what I'm looking for, how do I know if I can get it? To qualify, the electronic application process is just a pre-screening process that lets us see if you even would medically qualify for life insurance in general. Often people think there'd be a whole medical exam, but that's not even necessary based on your age, and if you answer a few questions, and as long as you're not constantly skydiving and scuba diving, then ultimately you're going to be likely approved in either a preferred or even maybe preferred plus healthcare rating. So that's something that's very interesting, is even our illustration might get updated to be even more tax-free income and less to the cost of insurance, and that's very favorable. But we have to find out if you apply to just see if you qualify. It doesn't impose any cost or obligation. It simply lets us know if the structure is available to you. If it's not, maybe your spouse is eligible. If it's not, maybe your child is eligible. Maybe we pursue a different strategy entirely. And finally, I'd leave you with this. When you finish this presentation, hopefully you did, it's pretty long, but when you finish it, you're going to Google Index Universal Life. And there are plenty of YouTube videos and blog posts explaining why Index Universal Life is terrible. And I can refute almost every argument you will see. I've tackled almost all the major ones in this very presentation. It is simply silly to look at sort of blanket objections to Index Universal Life. It's going to depend on a client, their circumstances, their lifestyle need, what accounts they have, what mission they have. And certainly if they're young enough and healthy enough and have the surplus assets or an inheritance, this can be extremely favorable, and none of those critics can know what the market's going to do, and none of them can know what tax rates will be, although we can almost all predict they will likely be higher in the future. So as a counterpoint to anyone who can write a blog, why don't you also look at some scholarship and people who really take this stuff seriously? Some of the best books out there about this include The Power of Zero by David McKnight, and he had a follow-up book called Tax-Free Income for Life. And another book I'd recommend is The New Holistic Retirement by Martin Ruby. Fantastic books, not very long, affordable. This presentation, if I send it to you, has hyperlinks to get those books. If you want to be deliberative, that's good, but read up from actual scholars and people who take this stuff seriously and have been industry veterans, not just anyone who could post a blog online and say anything. So that to me would be my ask of you. And let's get serious and let's get together and let's figure out how to make this a reality for you, that we have at least a portion of your retirement income free of market risk and free of unknown, uncertain, but likely higher tax rates in the future. Again, Matthew Taub.